If you have over $1 million in an IRA or a 401k, the IRS is not so patiently waiting for their cut of up to 40% or more from your required minimum distributions. But I have good news for you too. I'm going to show you the exact methods I use with my clients to help you avoid overpaying the IRS and keep more money in your pocket. Now, you of course don't want to be like the many other retirees who fail to plan or passively plan. That's what causes the required minimum distribution or RMD problem that I'm going to help you solve. So I want to start by showing you just how giant of a problem this can be and compare that to a successful plan when we implement the methods I'll then share with you. So let's look at John and Mary's retirement income plan. They've done a great job of saving for retirement. Their ages 65 and 63, still 8 years from needing to take John's RMD and 12 years for Mary. So they have $3 million in investments. Specifically, they have over $1.8 million in pre-tax accounts, an IRA and a 401k that'll be subject to RMDs that are fully taxable when distributed. These were pre-tax contributions, which are most common for 401ks. And that's not bad in itself. But like John and Mary, we'll want to work on creating a better scenario now that you're closer to retirement or in retirement. John and Mary also have Social Security and a small rental property to help supplement income. So when we run a broad long-term cash flow projection, what we find is they're actually on pace to overpay federal income taxes by $1.6 million. That's a huge amount. That does factor in inflation 30 years into the future. So even if we show it in today's dollars, it's still paying $581,000 of overpaying taxes. Now, you can see here that they are projected to pay little tax in these early years. That feels really good. But take a look at these later years when RMDs kick in. Taxes get really high. Well, this new and improved plan where we turn this around and save $581,000 in taxes is a result of using the methods that we'll get into now. And I should say, once I share with you the 8 methods to get to this more successful outcome, there's a key factor that many people miss in tying it all together. I want to make sure you see that towards the end. So method number 1 starts with smoothing out this tax exposure. Here's where most retirees and even a lot of tax pros get this wrong. They plan only for today. And what I mean by that is the common question is, how can I keep my tax for this year as low as possible? So one of the questions I get a lot is, which account should I withdraw from first in retirement? Unfortunately, many retirees default to an order which they start with their brokerage account, so they don't pay tax on withdrawals. They only pay tax on capital gains tax on what they sell within the brokerage account, and this tends to be tax favorable. And then they go to the pre-tax IRA and 401k money, and finally leave the Roth, the tax-free money, to the end. That's not terrible, but it's not often the best. When you have a large IRA, those early years of retirement with low tax exposure can provide this mirage of safety when the tax bomb's waiting to go off in a few years down the line. We call these early years the tax valley. Creating an optimized income plan means you find the right combination of income sources from the start of retirement, or if you're already retired, starting today. This may mean actually taking some IRA income early, as long as you can take that income at the lower tax brackets. In other words, would you rather pay 10 or 12 or 22% federal income tax rate now on that IRA income, or pay 24 or 32 or 37% later when it's all bunched up? Our next 3 methods, I'll explain how to make your optimized income plan even better. Method number 2 is simple. You've heard that you should diversify your investments, have US stocks, international stocks, maybe some large cap, small cap, even some bonds. But what about tax diversification? I mentioned that contributing to retirement plans on a pre-tax basis is most common. Again, nothing wrong with that, especially if your working income is high. But if you're in the home stretch to retirement, giving up a little tax savings for today to build accounts with different tax exposures will give you more flexibility for retirement income. So consider contributing in a more diversified approach, pre-tax, Roth, and some taxable accounts. Let's look at another method to create this tax flexibility and further take advantage of this tax valley. Paying some tax at low rates in the valley in exchange for reducing that waiting tax bomb can be a really good trade-off. When you convert pre-tax IRA money to the tax-free Roth bucket, you pay the tax for the amount you convert in the year of conversion, and then after 5 years, and as long as you're past the age of 59 and a half, that money from your Roth conversion becomes available to you tax-free, presumably after it's grown. So more money in your Roth bucket, especially if it has had time to grow, can be a huge benefit. It can give you a ton of tax flexibility because then you can navigate the tax brackets wisely. I like to tell my clients, generally, we want to hold on to Roth assets. We want to defer using them, but then use them very strategically. If your income is, let's say, pushing up against one of the higher tax brackets, and perhaps you have a year where you need to buy a car or take a big trip, that Roth money can come in and save the day by providing what you need for your income without pushing you into the higher tax bracket. With method number 4, as you know, you can start Social Security as early as age 62. You also have what Social Security calls a full retirement age, around 66 or 67 based on your birth year. That's like your base calculation year. If you take earlier than that age, you take a discount for the rest of your life. Conversely, if you defer past your full retirement age, your Social Security income benefit increases by 8% per year until it maxes out at age 70. There are lots of opinions on the timing. Some people say take it early, you can always invest it if you don't need it. Others will say, just wait, get it as high as possible. That way it provides some protection if you live a long time. I don't have time to dig into the pros and cons here. We do talk about that on other videos. But when you defer Social Security, you can help to extend that tax valley. This can give you more opportunity for Roth conversions and essentially setting up your investments for those RMD years. So factor that into your decisions around the timing of taking Social Security. Of course, if you defer Social Security, you'll need to find another way to receive that income, possibly drawing more from your investments. Well, method number 5 can help bridge the income gap as well. But let me preface this by saying this method is an option that may make your finances better, but you have to consider if it'll make your life better. So I simply want you to know that working longer can allow you to defer RMDs. Let's say you hit your RMD age and you're still working. You'd not be required to take distributions from your 401k at that job as long as you don't own 5% or more of the company you're working at. You would still need to take RMDs from your IRA, including if you have any SEP, simple IRAs, or even old 401k plans that are separate from your current employer unless they're rolled into that current employer's plan. I've included an IRS link in the description as you'll want to be really clear on the rules if working applies for you. But remember, this method is for those in that specific situation, and as a general rule, you may not want your RMDs to dictate your life and your retirement decisions. This is so important to get your RMDs right because a major penalty applies if you don't. And that brings us to method number 6, which is calculating your RMD correctly and consistently. Some people take too much or too little as an RMD. Either causes more taxes. So the common reasons for taking too much RMD are usually either simple miscalculation, or in the case if your spouse is at least 10 years younger than you, you'd work off of a different IRS table for the calculations that allow you to distribute less. In that case, you'd want to use the joint life and last survivor expectancy table instead of the uniform lifetime table. I'll drop a link to the IRS page that has these tables in the description down below. The penalty for taking too little or not taking your RMD at all is a stiff 25%. It used to be a whopping 50%. If you miss an RMD, of course, first talk to your tax professional, but usually you'll want to correct it as soon as possible. IRS Form 5329 can be filed, and the penalty may be less severe if corrected in a timely manner. As always, rules can get complicated, so work through your situation with your tax and financial professionals. And method number 7 should also be a part of your conversations with your financial advisor. We've all heard of asset allocation, but how you position your investments can impact your RMD. So let's say you're targeting 60% stocks for growth and 40% bonds and cash as more conservative elements of your overall moderate investment plan. Of course, the stock can be further diversified to some international, large and small companies, but we'll keep it simple for this example and lump stocks together. And let's say you apply this plan across your IRA, your Roth IRA, and your brokerage or taxable account. It'd be reasonable to presume that these accounts would grow at roughly a similar rate of return. But what do you really want to grow the most? The Roth, that's tax-free. It also does not have required minimum distributions, and it's typically last in line for withdrawals, or as I explained before, it can be withdrawn strategically to keep taxes at a minimum. The bottom line is the Roth money typically has a longer time horizon, it can afford to have more of the growth assets that will fluctuate, but hopefully give you a higher long-term return. Pre-tax IRA accounts, on the other hand, that will require distributions may be withdrawn sooner, but also are generally a better spot for more conservative assets in your overall investment portfolio. And this also helps to minimize RMDs. We call this method asset location, and it helps put your investments into the appropriate account. Now, a couple caveats to this. It's not that you don't want your IRA to grow, you do. But if you have conservative assets as part of your overall asset allocation, an IRA that will be fully taxable when withdrawn, especially for RMDs, is the better place to keep slow grow assets. Secondly, and this requires you have a plan that's customized for you and your optimized withdrawal plan, because you likely don't want to go to extreme with asset location decisions. In other words, if you plan or if there's a chance you'll need to withdraw from your Roth IRA or even your brokerage account soon, and you're, let's say, 100% in stocks during a major downturn, well, now you'd be forced to sell stocks at a low point. So having some diversification in each account could still make sense, but you may generally want to lean toward more growth in the accounts that don't have an RMD. Method number 8 has been impacted big time from tax reform in 2018 with the Tax Cuts and Jobs Act. Now, this tax reform is scheduled to sunset after 2025 unless Congress extends it, so it bears watching how this plays out. One of the primary changes of the tax reform was increasing the standard deduction. For 2024, the standard deduction will be $14,600 for a single filer, plus $1,950 if you're 65 or older, and $29,200 for a married filing joint return with an extra $1,550 for each individual if married and 65 or older. Well, far fewer taxpayers are now itemizing their deductions. And so the amount of tax benefit from typical itemized deductions like state and local taxes, mortgage interest, and charitable contributions is greatly reduced. So when a prospective client asks us to help with their retirement planning, one of the next steps we take is to review their tax return so we can begin just brainstorming strategies to make their money go further. Well, many are surprised to hear that they are getting little or no tax benefit for their charitable donations. But the good news for retirees is those age 70 and a half and older can make charitable gifts directly from their IRAs. This is called a qualified charitable distribution, or a QCD. And this has two tax benefits. It can proportionally satisfy your RMD, and best of all, it doesn't show up as taxable income. Let me show you a quick example. Scenario 1 is the tax scenario with the QCD, and scenario 2 is without the QCD. So you can see their total RMD was $58,000, but they gave $11,000 as a QCD in scenario 1. In their case, this was money they were already giving away. By shifting how they gave it as a QCD instead of writing a check, they saved $2,400 in federal income tax and stayed in the 22% tax bracket. Saving state taxes as well made this even more beneficial. And finally, even if you know all these strategies and you're able to apply them to your plan, you may be missing one key factor. See, I've given you 8 methods to decrease your RMDs, but there can be too much of a good thing. The reality is good tax planning finds ways to save taxes and ensure the benefit is greater than the cost. But there's still a cost usually, like when we discussed Roth conversions, and you pay a tax in the year of conversion, or you contribute to a Roth instead of your pre-tax 401k contributions. You're giving up some savings now in order to save later. But there's a sweet spot to all this. If you overdo your upfront costs, then there may be nothing in that pre-tax bucket to do qualified charitable distributions, which means you paid for something you didn't need to. Or even if the QCD is not for you, possibly you gave up some pre-tax savings that you could have withdrawn in retirement at the extremely low tax brackets during retirement. That sweet spot is the key to putting it all together. And you can learn more about that in action with a real client case study my partner Alex previously posted. He shows you how this client with a lot of pre-tax retirement money saved a bunch in taxes with good planning. The link is up here or in the description down below. You'll want to watch that video next. And if you want to see if my firm can help you with your retirement planning, we always start with a simple phone call. Check out the link in the description if you'd like to talk with one of our certified financial planners. We'll catch you on the next video.